we've had one heck of a run, folks. I mean, when you think the Great Recession of 2008, 2009, and how we all felt back then, and the market lows, and everybody thought that it was going to take 10 years to recover. Well, the market has tripled, the S&P. Tonight when we talk market, we'll talk the S&P 500 index, and that has tripled over that time period, and that's pretty good. We had last year, which was a year where the market was, if you look, we have 3 months where the market was down, but fundamentally, the market was pretty strong all through the year, being up over 12% again. The year before that, 32%. The year before that, 16%. It's been pretty good for those investors that stayed invested in the market. And we know we're going to have good days, good weeks, good months. I guaranteed each and every one of you when you signed on as a client that you were going to lose money. Maybe for a day, maybe for a week, maybe for a month, or like a year, 2008, for the entire year. But if you stay focused and your discipline is in the right place, your goals and objectives, and you're investing for the right reason, and as long as you can take the comfort level, whatever the mix of investments that you're in, and I've shared this with all of you, 100% of my personal wealth is invested just like each and every one of your money is. I wouldn't have it any other way. I love to cook. I would never invite you to my home and cook for you and not eat my own cooking. I eat my own cooking. I invest my money the exact same way that your money is invested. I'm in our growth strategy. I'll be 58 this year. I'm very comfortable with the risk that comes with that. Right now, that's about an 80% stock, 20% fixed income, cash, alternative asset mix. And the only difference is for those clients that may be in a growth and income balance, conservative, or capital preservation, I may own more stocks than you, but we own the same stock investments. We own the same bond investments, the same real estate investments. I wouldn't have it any other way. And last year, we were very happy once again with our returns, and hopefully you were happy with your returns as well. So, to cap it off, 2013, domestic large cap were up almost 33%. 2014, 14%. Year to date this year so far down 0.3%. Small caps, 39% in 2013. 5% in 2014, down 0.6%. International, up 23% 2013, down 5% 2014, 1.3% on the positive year to date. Emerging markets down almost 3% 2013, down over 2% in 2014, up over 2% year to date. And then when we go down to bonds, in 2013 down 2%, the 2014 return up almost 6%, so far this year up almost 2%. In commodities, we don't own any commodities, thank God. Down almost 10% in 2013, and we sold all of our commodities when gold reached almost $1,900 an ounce in September of 2011. I like to brag about that. Sometimes in our business we don't get to brag all the time, but I like to brag about that. In 2013, commodities were down almost 10%. 2014, 17%. But year-to-date, kind of flat, down 0.3%. What this slide shows you is in each and every one of your portfolios, for all of our clients, we're well diversified. If we invested all of our money in small caps in 2013, we would have had one of the more weaker returns in the equity market in 2014. Whereas international, 2013 was great, 2014 not so great, but so far year to date we're doing well. And an area that we've been waiting to do better is emerging markets. 2013, 2014 we hung in there, and year to date we're up over 2%. That's a good picture of why we're diversified, because you never know which sector of the markets are going to do better or worse. What we don't do is invest in last year's winners. We try to really pare back. We'll take some profits. Sometimes we'll take profits early. Sometimes we'll invest areas early. Sometimes we're early to the party, as they say. But long term, we're very comfortable with our methodology. Ryan, Marty, and I meet week in, week out to talk about each and every investment. And unlike a lot of firms, every investment we buy and sell, every one of our clients owns somehow, some way. So if we have a good idea, we want that to go into each and every client's portfolios, and that's one of the reasons why we've invested a great deal of money, over 6 figures in the last 2 years, in our systems so that we can better manage your portfolios. And we feel that if we have a good idea, we want every client, whether it be a client who came on board this week, last year, or as one of our clients said, I've been with you for 23 years, that's a long time. We want every client to experience our good ideas and our bad ideas we're going to take out of your portfolios when we feel that the time is right. Because sometimes we have something that it's time to take profits. Sometimes we have an investment that did not work out the way we wanted to, and we'll admit to that and we'll take it right out of the portfolio. So we're really, our methodology, our discipline, and the 3 of us meeting every week with all the research and everything that we have at our disposal, hopefully you're happy with the end result. Now this is the roller coaster ride. This is not today's market. Today's market was similar. But when you go back to 1997, as you can see, the markets went up. Back in 2000, if you remember, that's just before the tech bubble, we had a PE ratio of 25.6. And in 2000, we had dividend yield of 1.1. The 10-year Treasury was yielding 6.2. And then the market crashed, came back up. So if you can almost imagine, 7 years later, 2007, October of 2007, you were almost where you were in March of 2000. In 2007, we had the S&P was at 1565. In 2000, it was 1527. So almost exactly the same. The PE ratio was 15.2. The dividend yield 1.8. The 10-year Treasury at 4.7. We know what happened in 2008, 2009. And then all of a sudden, we had this great spike again. And here we are today. And we have today, the S&P is at just over 2,000, between 2,000 and 2,100. The PE ratio 16.2. The dividend yield almost 2. The 10-year Treasury 2.2%. This is what happens when you're invested. This happens to be the stock market. We'll go into bonds later on in the presentation. But this comes with the territory of investing. And when the market goes down, if anything, you don't want to panic and sell because you're never going to recover. If you sold here, you're never going to recover. If you sold here, you're never going to recover. And that's what we get paid to do, is take that emotion out of the decision-making process and hopefully make those decisions on your behalf. We care about your money as though it's our own, and for me, it is my own. Investing the same way that you do, but we really pay attention to our investments and all the securities that we own. So when you see a bad day in the stock market, long term, it's expected, it's guaranteed. Well, Marty.
I'm trying.
Marty acts as our compliance officer. The next slide is the guaranteed returns for 2000. He won't go there. So, now this is probably a great slide. I mean, going back to the turn of the last century, we had a flat market, then the market went up, and we know what happened in the Great Depression. 1937 and 1948, flat market, the market went up to 1966. For those of you that were invested back then, the Nifty 50, you probably remember that slogan, the 50 stocks. And the markets were really kind of terrible in that time. The Nifty 50 didn't do a whole lot. The price of gold was $35 for 35 years. You had the unraveling of the price of gold to the US dollar. A lot of things happened. And then all of a sudden the markets went up. If you really think about it, over the last several decades. And here we are, 2000 to the present. Once again, where will the next move be? Could we be in a secular bull market? We're optimistic. And we get paid the same whether we have you invested in stocks, bonds, commodities, or cash. Whether it's FDIC-insured CDs or the exchange-traded funds we use for our equity positions, we get paid the same. So we don't get paid any differently to be positive on the stock market, but we are optimistic that the stock market will do well over the next several years, and you'll see during the presentation why. And for those of you that, and everybody has some stocks in their portfolio, it's a good thing long term. This is a good reason why. Where are we now? Where will the markets go? We've come off a horrendous Great Recession. A lot of economies around the world are still recovering. Where will we go? The U.S. economy is doing much better. We'll talk about that later on in the presentation. And then, real quick, all of the valuations are undervalued. When you look at price to book, price to sales, undervalued, price to cash flow, and EBITDA, we're all under the averages, and we think that's a positive sign for the market. And when you look as an asset class, the green line is the U.S. Treasury 10-year real yield. That's the yield after inflation. And as you can see, if you lock up your money today, the yield today, I think, is less than 1.8%, which is this light blue line. This was the end of December, but right now, today, it's less than 1.8%. So you could literally lock up your money for 10 years and get 1.8%. We don't recommend anybody do that because we think interest rates will go up. We're confident they will go up. We just don't know when they will go up. But we know with patience, you'll be rewarded. And when you look at stocks, this dark blue line, this is the S&P earnings yield, and this is almost at 6%. When this line is down closer to the 10-year Treasury, that means the market's overvalued. When you see the wide discrepancy, that means the market is more undervalued. This is a slide we like, and it kind of proves our conviction that the market may be still undervalued and there's a place to go.